Dubai's shimmering skyline. You see it everywhere. It often conjures these images of, well, unshakable investment, right? A seemingly endless ascent of opportunity. But what if the ground beneath those gleaming towers is shifting, maybe far faster than the public narrative suggests?
Right.
Today, we're taking a deep dive into the dynamic world of Dubai's investment real estate market.
Yeah.
Our mission is really to cut through the noise, bypass the headlines, and bring you the raw, unvarnished truth about where the market is truly heading. We want to explore the emerging trends and opportunities that might not be immediately obvious. And we've meticulously pulled insights from the most recent granular reports, not just those broad annual summaries, but the month-on-month data from the ground, drawing on a range of industry leaders.
And it's remarkable, actually, how quickly the widely accepted narrative starts to fray once you delve into that more granular data. The month-on-month, the quarter-on-quarter stuff. It truly paints a different picture than the common year-on-year reporting that gets highlighted so often. This really makes you wonder, are we simply witnessing a minor market correction, or is something far more significant at play here?
Okay, let's start there. I've been looking at the rental market, and some of the figures I'm seeing are quite surprising, maybe even alarming. The rental sector, it's often considered the bedrock, right?
Yeah.
Of a property's intrinsic value, a key indicator of real demand.
Absolutely.
But it seems to be showing some genuinely alarming cracks. What are you seeing in the latest data?
You're absolutely right to highlight the rental market. Official data from sources like Property Monitor presents some truly stark statistics. Look at this. Over the last 16 months, rental transactions have plummeted by 44%. 44%.
Wow.
And if we narrow that down just to the past 6 months, it's still a staggering 43% drop.
Okay.
And just looking at the most recent 2 months, we've seen a 23% decrease month on month in rental deals being done.
23% in just 2 months.
Yeah. And what's striking here is that almost no one in the public market conversation seems to be discussing these specific figures. It's quiet.
But isn't that a complete counter-narrative to what we often hear? The general optimism. How do you reconcile these official figures with that?
It's a critical point. The silence is deafening on these specific numbers, which is precisely why we want to bring them to light today. Now, we have heard one industry CEO recently forecast a 10-20% drop in overall property value for the year. Just one voice, but it was out there.
10 to 20%. How does that compare? Is that normal?
Well, to put that in perspective, typical corrections in major global cities, think London or Singapore, they're usually in the range of, say, 1 to 3%, maybe slightly more, but rarely double digits.
Okay, so 10-20% is way beyond that.
Exactly. A 10-20% projected drop clearly exceeds a standard correction. It certainly challenges the idea that this is just a minor blip.
So, okay, let's connect the dots. What does this truly mean for property owners on the ground? Because when properties aren't getting snapped up for long-term rentals, they can sit vacant for months, right?
That's the reality.
And those empty months still mean accumulating mortgages, service charges, all those overheads.
Yeah. I've heard countless stories of owners finding their expected annual income just collapsing because of these lost vacancy periods. It's not just a statistic, it's real financial pain for owners.
Exactly. And that challenging environment is pushing many owners, quite understandably, to consider short-term rentals as a crucial alternative. It offers immediate income, which is vital for covering those ongoing costs you mentioned. But beyond that, it provides crucial flexibility. It allows owners to avoid being pressured into a rushed sale in what is clearly, based on this data, a softening market.
Right, gives them breathing room.
It lets them bridge the gap, get some revenue through the door, and maybe wait for more favorable long-term opportunities or perhaps a better sales price down the line. It's becoming a strategic pivot for many, not just a preference.
Okay, so that's the rental side concerning figures there. Now, if we pivot to the sales side of the equation, because that market is also undergoing a pretty significant transformation from what I'm seeing. What's the latest there? Yeah, the sales market data reveals another really fascinating dynamic. Recent reports show overall transactional sales volume saw a 5.65% month-on-month decrease.
Okay, month-on-month down 5.65%.
Right. And then if you compare Q1 of this year, 2025, to Q4 of last year, 2024, total sales transactions are down 10%.
10%, quarter on quarter.
Yes. And breaking it down further, this is interesting, off-plan transactions, those properties not even built yet, they decreased by 12%. And secondary transactions, so sales for already built, ready units, they fell by 5.4%.
But what really jumps out from the data I've seen is just how dominant off-plan properties have become overall. Is it true they now make up the vast majority of transactions?
Absolutely. That's the striking trend, the sheer dominance of off-plan properties.
Yeah.
Depending on the report you look at, it's somewhere between 64% and 69% of all transactions now involve these unbuilt units.
Wow, nearly 70%.
And this percentage is consistently growing. It strongly signals a market driven heavily by investors and, well, maybe speculators, buying into future developments rather than end users looking for a place to live right now.
Which begs the question.
Exactly. Who is actually going to live in all these places once they are completed?
That's the puzzle, isn't it? If rental transactions are significantly dropping and sales in the secondary market for existing homes are also in decline, it raises that really important question. Where are the reported, 1,000 new residents arriving daily actually living?
Yeah.
Because the available data suggests they might not be buying or renting in the traditionally popular, prominent areas that most brokers tend to focus on. It's a real head-scratcher.
And anecdotal evidence from the ground certainly suggests this mismatch. If you drive around newer areas, say Jumeirah Village Circle, JVC, or Arjun, many of the recently completed buildings are noticeably under-tenanted.
Really?
Yeah, some reports, although anecdotal, even suggest occupancy rates as low as 20% in some buildings.
20% occupancy.
It implies that while the overall population might be increasing, as the headlines say, the demand isn't translating into occupancy in the specific areas where the most new supply is concentrated. There's a disconnect there between the macro population growth figures and the micro reality of housing absorption.
Okay, so we have sales volumes dipping, rental demand softening. What happens when we factor in the sheer volume of new supply that's heading our way? Because we're not talking about a mere trickle of new properties anymore, are we? It sounds more like a potential flood.
You're not exaggerating. The supply figures are quite something. So far in 2025, over 66,000 residential units have already been launched.
Just this year so far?
Just this year. And projections indicate around 73,000 will likely be added to Dubai's housing stock this year in total. But looking further out, the pipeline is even bigger. Research suggests approximately 300,000 units are expected to hand over by the end of 2028.
300,000.
Yeah, it paints a very, very clear picture of inventory levels about to surge.
So are we talking about a simple imbalance here? Or is it something much more significant when we look at that supply versus population growth forecasts?
Well, one critical analysis highlights this very clearly. Dubai's housing stock is forecast to grow by around 16% over the next few years, but population growth over that same period is only expected to increase by about 5%. 5%.
16% supply growth versus 5% population growth. That's a big gap.
It's a huge gap. It translates to an estimated 210,000 new units entering the market in just the next 2 years alone. That's a clear signal of significant oversupply that the current population growth simply can't absorb at current rates. It's not just an imbalance, it's a dramatic expansion of available properties.
And the pace of these new launches, it's accelerating dramatically, isn't it? I read somewhere it felt like a new launch every few hours or something crazy.
Yes, the pace is astonishing. In 2024, a new property project was launched, on average, every 18 hours.
Okay.
This year, 2025, that pace has picked up significantly. It's now closer to a launch every 12 to 13 hours.
Wow.
If that continues, it could potentially lead to 140,000, maybe even 150,000 new property launches just in 2025. That would be an all-time record high.
And what kind of properties are these mostly?
Well, a significant observation is that the majority of these new launches are actually low-rise buildings.
Not the usual skyscrapers.
Not the iconic high-rises Dubai is famous for. These low-rise buildings are generally quicker to build and hand over. So this rapid construction cycle could potentially accelerate the market's inventory levels even faster than people expect.
Right.
We've even heard some anecdotal reports, quite surprising ones actually, of some developments handing over a full year earlier than originally projected, which, for Dubai construction timelines, is quite unprecedented and only adds to that sense of imminent supply surge.
Okay, so the real question then becomes, what happens when all this new supply, especially the faster low-rise stuff, hits a market that's already seeing declining demand for both new rentals and secondary sales? What does it truly mean for prices and returns, especially when we dig into some of the comprehensive Q1 2025 reports from prominent market players you mentioned?
Exactly. And those reports, they lay out some really stark figures that tie this all together. Sales transaction volume, as we said, down 10% quarter on quarter. But look at prices. The average apartment sales price down 16% in Q1 compared to the previous quarter.
16% down on average apartment prices quarter on quarter.
That's what one major report indicated for Q1. Then on the rental side, rental transaction volume down 14% quarter on quarter, okay? But year on year, a massive 28% drop compared to Q1 last year.
28% fewer rental deals year on year.
Yes. And maybe even more telling, new tenant registrations, people actively looking for and registering new leases, they saw a sharp 33% decline year on year.
33% drop in new tenants. Okay. When you list it like that, 8 out of 11 key metrics showing double-digit decreases. It really does force us to reconsider if correction is the accurate word. But isn't correction the industry's preferred term? To avoid causing panic, what's the real danger if we shy away from maybe using a stronger word?
That's a crucial point. While correction implies a sort of healthy, temporary rebalancing, these figures, particularly the depth and breadth of the declines, suggest something potentially more profound. And if we connect this back to the rental market, remember the finding that 70% of Q1 2025 rental transactions were actually renewals.
Right, not new tenants.
Exactly. It indicates a significant drop in new tenant activity. The danger of using a softer term like correction is that it might mislead investors or owners about the true underlying market dynamics. Because when demand for new rentals is drying up like this, it creates a clear domino effect. It's almost inevitable.
What kind of domino effect?
Well, first, rental prices come under pressure. They start to come down, which in turn directly reduces the return on investment, the ROI, for property owners.
Okay.
And that lower ROI then inevitably leads to either a lack of buying interest from new investors, or it leads to potential buyers demanding significant price reductions to achieve the returns they want.
Makes sense.
All the indicators we're seeing suggest this is just the beginning of that dynamic playing out in the broader market.
Right. Okay, so given all this market data, the falling transactions, the price pressure, the incoming supply, here's a truly intriguing puzzle that maybe you can help unpack. New property launches and these under construction off-plan properties, they're currently priced at almost double the price per square foot compared to existing ready apartments in prime locations like, say, Dubai Marina.
Yeah, that disparity is noticeable.
And even citywide, they're still commanding more than a 20% premium over ready properties. So the question is why? Why are off-plan properties commanding such a significant premium, especially when they come with inherent risks like construction delays, market shifts, and, crucially, they don't provide any immediate rental income?
It seems counterintuitive on the surface, doesn't it?
Yeah.
But we can deconstruct this into a few key reasons. And it's really essential for anyone looking at investment opportunities here to understand these drivers. First, a really significant factor is that over 60%, maybe more now, of buyers in Dubai are non-residents. They live overseas.
Okay, majority non-resident buyers.
Exactly. And for them, buying off-plan is considerably simpler logistically. It often doesn't require a physical presence in Dubai for the whole process. They don't necessarily need a local UAE bank account or bank check initially. Funds can often just be wired directly to the developer from overseas.
Easier paperwork and process.
Much easier. The secondary market, buying a ready property, by contrast, typically requires local checks, physical presence for signing contracts at the land department, or incurring additional costs for setting up escrow services and power of attorney arrangements. So that ease of transaction for off-plan is a major draw for international buyers.
Okay, that makes sense. What else?
Second, something smaller but still relevant is agency fees. For off-plan purchases, the typical 2% real estate agency commission is usually paid by the developer, not the buyer.
So the buyer saves that upfront cost.
Correct. It seems like a small percentage, but on an expensive property, it's a tangible saving that makes off-plan slightly more attractive financially at the point of purchase.
Got it. Ease of purchase, no agency fee. What's the third factor?
And third, perhaps the most powerful driver, is payment plans and leverage. Off-plan properties almost always come with attractive, structured payment plans spread over the construction period, and sometimes even post-handover. This allows buyers to enter the market with a much smaller initial down payment, sometimes as little as 10%.
Lower barrier to entry.
Exactly. Plus, investing a certain amount often opens pathways to obtaining a 10-year golden visa, which is a long-term residency permit tied to property investment, a big incentive for many non-residents. But the key thing here is the leverage effect these payment plans create.
Explain that leverage a bit more.
Okay, so Imagine a property's value increases by, say, 20% during its 4-year construction period. An investor using a payment plan might have only paid, let's say, 50% of the property's price by the time it's handed over.
Right.
That 20% increase in the total property value actually translates to a 40% return on their invested capital, the money they've actually paid out. That potential for amplified returns is a very, very appealing prospect when the market is perceived to be rising.
Okay, I see. Double the return on your actual cash invested. That sounds incredibly attractive for the buyer.
Yeah.
But where's the risk in that leverage? Because it feels like it has to be a double-edged sword.
It absolutely is. You've hit the nail on the head. While that leverage is incredibly attractive when prices are appreciating, the exact same leverage effect dramatically amplifies losses when property prices decline.
Ah.
So if that same property's value dropped by 20%, the investor who has paid 50% would see their invested equity potentially wiped out or significantly reduced, a much worse outcome than the overall market drop. It catches many unprepared when the market turns.
Right, so your losses are magnified just as much as your gains.
Precisely. So for you, the listener, the crucial takeaway here is really this. For an off-plan investment to yield positive financial results, especially with that leverage involved, it requires strong, consistent, positive price momentum, particularly in the specific micro segment of the market that you're buying into.
Oh.
But as we've discussed today, the current data across the broader market suggests this momentum is slowing or possibly even reversing in many segments outside of maybe very specific ultra-high value niche areas that might still see some insulated demand.
So, this deep dive has truly revealed a market that seems to be at a significant turning point. It's characterized by, well, increasing supply, definitely slowing transaction volumes, and signs of declining prices and rentals in many segments. The trends we've discussed today really point to an unpredictable period ahead, particularly for those relying on those traditional long-term rental models, or perhaps purely speculative off-plan purchases based on past performance. It's a very different picture from the one often painted in glossy brochures.
And it's vital to reiterate where this information comes from. The figures we presented today are sourced directly from official DLD data, that's the Dubai Land Department, and from reputable, widely used industry reports. They reflect the true, fast-paced, and sometimes volatile nature of the Dubai market. It's absolutely crucial for anyone looking at investment opportunities here to focus on that month-on-month and quarter-on-quarter data we highlighted. Don't just rely on the broad year-on-year statistics that are often highlighted, sometimes by those with a vested interest in just making sales.
Yeah, look deeper.
Look deeper. While Dubai has undeniably seen incredible historical growth, the current dynamics we're seeing suggest a need for, well, extreme caution, and perhaps a greater reliance on independent, impartial analysis before making decisions. For truly independent guidance that aims to cut through the sales hype, you might consider reaching out to someone like Adrian Rawls. He's a financial advisor based right here in Dubai Marina.
Adrian Rawls.
Yes. You can easily find him on LinkedIn or just by searching his name online. He's known for offering insights that might not always be shared by typical sales agents, really providing more balanced reflection of the market shifts, the trends, and the underlying dynamics. Worth looking up if you need that independent view, because the market is definitely changing, and by all accounts, based on this data, we are likely just at the start of it.
A really insightful discussion. So as you navigate this evolving landscape, remember the importance of staying informed and seeking out those truly independent insights. What stands out to you most from today's deep dive? And perhaps more broadly, what questions does this raise about the future of real estate investment in dynamic, fast-growing cities like Dubai? Something to think about.